short-term regret aversion bias causes us also to make some tremendous mistakes because we're engaging in activities that minimize short-term regret or minimize the chance for short-term loss. That's what human nature wants. We don't want the investment or the activity that's going to benefit over the long term, whether it's investing or eating. I want to eat the potato chips because I like them now.
Yeah.
The fact that in the long term it's going to kill me, I worry about that later. It's the same thing with investing, right? I want to invest in the thing that I know when Trump is there is not going to go down, and I'll keep it there for 4 years, even though it's probably going to kill me.
Yeah,
totally.
Yeah. Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. And together with investors, we're investing in over 1,000 multifamily apartments under renovation and over 500 single-family rental homes that we're developing. And we're also expanding into private debts, oil and gas, industrial commercial real estate, and a host of other asset classes to create a balanced and diversified portfolio. Before we begin, just like always, a quick disclaimer: we're not financial advisors. All investments are subject to risk, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA, your tax attorney before making any investments. So again, I'm your host, John Lai. Welcome to today's episode. What are and how do you identify common investor behavior biases? And how can you, the investor, modify these behaviors? We have our guest today, Jonathan Blau. Jonathan is the founder and CEO of Fusion Family Wealth, and he will help us unpack some psychological pitfalls that even informed investors fall into. And I'll learn a ton this episode. So welcome, Jonathan. Thank you for joining us today. For those who don't know your background, can you give a little bit about how you got to where you are today?
Sure. Pleasure. Thanks for having me join you, John. I appreciate the opportunity to address your audience. And so how did I get to where I am today? So I started off, my first stint in the money management or wealth business was with a firm called Lehman Brothers that's no longer around. And that was summers of 1987 and 88, where I was an intern in college. And then I recognized quickly that what they were doing at Lehman Brothers is just making pitches or presentations using what are called Dun and Bradstreet cards that identified wealthy investors. You bought them, thousands of these little cards, and it told you how much money the person made and how to get in touch with them. And you would just sell them an idea. And that's how Lehman Brothers evolved back then, from hiring people out of the Ivy Leagues to hiring literally IBM and Xerox salespeople, because they were the best salespeople from the best sales training programs. And they recognized that Lehman, if we want to make money, we need to hire salespeople, not people from Ivy League schools who don't know how to sell. And so I predicted back then in a book I wrote one chapter for, which I will finish now later on in my career, which predicted they would go out of business one day, and they did. So I have that saved. And then what I recognized then is I wanted to pursue a career where I learned the technical skills needed to help wealthy investors really succeed with their endeavors to protect and grow the capital they worked hard for. So I went and pursued an MBA in accounting and a Master of Science in tax. And then I went to work for one of the big 6 accounting firms, Arthur Andersen, and got my feet wet for 3-4 years in family wealth planning, everything from tax and estate planning to retirement planning. And only then went to Sanford C. Bernstein Company, which is now AllianceBernstein, when it was the largest privately owned wealth management firm, and learned to see how the wealth management practice really worked from an internal perspective inside a wealth management firm, in their training program at Bernstein for 6 months, where everyone was required to go through it. Whether you were like me, I was 29, the youngest person they never hired directly as an advisor. Most people were in their third career. They had big Rolodexes, and they went to Bernstein with their Rolodex and were able to just bring in clients. I was an anomaly, but everyone, including those people who were 20 or 30 years older than I was then and were in their third career, they had to go through the training program, and 2 days of the training program touched on behavioral finance. And so when I started my career at Bernstein, it was 1997. I built up my business to $100 million by 2000, and then it went down to 50 million by 2002 because of the
Right.
and the terrorist attacks. And then I rebuilt it again by 2007 back to 100 and some odd million, and then went down to 40 million because of a 60% decline just 5 or 6 years later in the credit crisis. And so that is how I got to where I am today. I realized that there had to be a better way to help investors and to run a smooth practice than to have to walk the same investors or the same cliff today that I walked them off 6 months ago, 3 months ago, and 3 days ago. And that's where I realized we got to do the lifeboat drill long before the bow of the boat touches the water and educate them about temperament, behavior, and this way the next crisis that comes along, their response may be that they feel the fear, but they'll no longer feel that they have to react to the fear by changing the portfolio.
That's great. Fantastic resume. I actually worked at Arthur. I switched over to the consulting division. And then
on the tax side, you were on the audit side.
I was on the audit side. Yeah. I saw the tax folks, and there was a sense of envy because I knew that they were helping. Audit, we were helping, but we were there more as a nuisance than anything else.
I understand. No, I get it.
And I also worked at Bear Stearns, which, I know about Lehman because we're very much kin. Also, they no longer exist.
The same fate. Yeah, it was the same fate around the same timing.
Around the same time. That's right.
Yeah. I once met with Allie Greenberg, H. Greenberg of Bear Stearns. They were looking at food as advisors when they started their own wealth advisory practice. Probably around 2007 or 8 or something like that. But we didn't pursue it. But it was an interesting guy. He was doing card tricks for us.
Oh, that's right. He was into his cards. Again, fantastic background. I'd be curious to know, you have a great experience based on both your background as well as accounting and tax, right? Very few advisors have that background, and coming from that background, I think it's beneficial to have that, right? I had an accounting degree undergrad, be able to then take that knowledge, base of knowledge, and then assist your clientele to help them understand and uncover a trove of potential benefits that the normal person doesn't truly understand, truly grasp, or maybe can't leverage because their investment base is so low. I'd be curious if you can talk a little bit about that.
Yeah. So having the accounting background, even early on, back in the early 90s, there's something called a sale to a defective trust, where the trust is set up in such a way where I can give a gift to the trust from the benefit of my children, and the assets, and then outside of my estate. But I now have to pay the income tax on it because it's a granted trust, which is even better because now I'm paying taxes, which gets more money out of the estate instead of the children's future assets having to pay the taxes. So that was sales to an effective trust, and what they called it a perfect effective trust. It was perfect for estate taxes, and defective for income tax purposes, which is why they granted me funding and how to pay the taxes. And just everything in between, from understanding what a backdoor Roth IRA is and what the particular potential pitfalls are. So if someone wants to set up a Roth IRA, which is an IRA where you don't get a current tax deduction, but instead you get a situation where you can grow tax-free forever, and you're not required ever to take the money out. But when you take it out, whether you're in the 70s or 80s, you never have to pay tax on it. Now, the Roth IRA is not eligible for earners that have something close to $200,000 a year in earnings. They're ineligible. But there's a secret trick called the backdoor Roth, where even if you're ineligible, you can fund a traditional IRA, and then you can immediately move it into a backdoor Roth, they call it backdoor Roth, even though you wouldn't have otherwise qualified. But the key there, and what's important as a tax professional, is something called the pro rata rule. So if somebody's trying to do a backdoor Roth and they happen to have a traditional IRA already, not a 401k, doesn't affect that. Traditional IRA, that traditional IRA will end up tainting your ability to convert that backdoor tax-free. A lot of people don't realize that. So some people try to do the backdoor Roth and they didn't realize, well, I have this $200,000 IRA, who cares? But that actually will make most of that conversion taxable.
Oh, that's interesting.
So a lot of people, even advisors, wouldn't know that. But it's a tax. So there's a whole bunch of things. I mean, keep going on and on, but it's helpful to have the tax background and even knowing how to research it and what to look for knowing, and even on a more narrow level, of one of the behavioral issues a lot of investors have, and the reason so many, one of the reasons so many fail is we have an ambiguity bias. So we don't like to invest in things that have less perceived certainty attached to the return that we're getting. Mm-hmm. So for example, a bond we like because we know every 6 months, if I put $1 million in the bond and it's paying 5%, every 6 months I get my $25,000 or whatever it is. And that feels very certain and comfortable to me. There's no ambiguity. I know that if it's a treasury bond and I hold it for 10 years, I'm getting that $1 million back. No ambiguity. When it comes to investing in stocks, there's a lot of ambiguity. And so what we often do is we would choose the more certain investment, the one with the bond income coming in, even if we know the probability in 10 years is that we're going to make a lot less total return. And so when people focus on income generation, yield and dividends, yield from bonds, they actually miss the boat because total return is where it's at. You want to know not how much of my water is coming from the rainfall in the well versus the snowfall, how much water is there, right? So I don't care. So knowing that the Internal Revenue Code, Section 61, defines gross income as, among other things, interest, wages, capital gains, that's income. Investors don't think of capital gains as income because of the ambiguity involved. So even something that basic, I can share that with a client to open their eyes a little bit about how better to think about their investment program and what's likely to benefit them. And behaviorally, how to get past the thought that, hey, that's not really income. That's principal. No, it's not. Capital gain, capital appreciation is income. You just don't have certainty affixed to when it's going to come and when it's going to depreciate.
Yeah, that goes back to when I started investing, there was a strategy to leverage stocks that had periodic defined income through dividends, right? Dividend portfolio is what you created.
High dividend payers.
Yeah. And that was certainly one strategy, but it's not taking the viewpoint that you can invest in stocks that could appreciate a lot faster. And at the end of a 10-year period, could perform a lot better, right?
Yeah, that's a good example. I mean, on the whole, again, it goes back to this ambiguity bias and also what I call myopic regret aversion bias. Myopic means we see things clear that are in front of us, but far away, we don't see it so clearly. So myopic regret aversion means we engage in activities that minimize the chance of short-term regret.
Right.
So I'll buy gold because I know it won't fluctuate, or I'll leave it in cash.
Yes.
But my long-term regret is going to be much deeper because the gold and the cash 20 years is going to be worth basically the same dollar, where the stocks would be worth at 7% a year, $4. And so short-term regret aversion bias causes us also to make some tremendous mistakes because we're engaging in activities that minimize short-term regret or minimize the chance for short-term loss. That's what human nature wants. We don't want the investment or the activity that's going to benefit over the long term, whether it's investing or eating. I want to eat the potato chips because I like them now. Yeah. The fact that in the long term it's going to kill me, I worry about that later. It's the same thing with investing, right? I want to invest in a thing that I know when Trump is there is not going to go down, and I'll keep it there for 4 years, even though it's probably going to kill me.
Yeah,
totally. Yeah. But by the way, with dividends, and I want to point this out. So with dividend stocks, so why does a company pay higher dividends on average than its peers?
To have investors invest in their stock?
No. Why? And the reason they do it is because their business isn't growing as fiduciaries.
Oh, I see. Right.
Fast enough to warrant investing in the business. Right. So they have to pay it out. So on a total return basis, on average, not everyone, but on average, a high dividend portfolio is going to give you a much lower long-term return than a not high dividend portfolio because the total returns are going. And so people don't understand these things. And that's really when, so behavior deals with all of this stuff. It's biases. It's the way we've been taught or mistaught to think about investing in money and really comes all together. And what we do is when we meet with people, it's almost, we take an approach much like a doctor's office approach. We're not selling, we're diagnosing and we're prescribing, right? We're finding out what's the issue, what's holding you back, why are you meeting with us? What's the concern you have about your current program plan, wealth strategy, and then we can figure out what's driving the issues that are bothering them.
Do you look at, and I'm sure this is the case, look at the investor and their current situation and also their portfolio to understand and diagnose exactly what their biases are and perhaps how they should approach their investment strategy? So for example, someone that's just starting out versus someone that has ultra high net worth, $10 million and up in their portfolio, and maybe at their sunset of their career, does that affect how you look at their biases?
So no, it really doesn't, because human nature is immutable. One, it doesn't change, doesn't discriminate. The Tiger 21 billionaires are affected with their billions the same way the person who's just starting out, whether they're the sons of. So it doesn't. So what I try to do, the way I try to diagnose it, is by having a conversation. So for example, we first teach them that what is risk, as they might define it, is a question we might ask them. What is risk as it relates to your money that you're investing and how you're investing it? How do you look at risk? And what would you say if I asked you, how do you define risk as it relates to your investment endeavors? What do you define?
Personally to me, or just in general?
Yeah, if it were you, I mean, it could be anyone, but yeah.
I would say preservation of capital, but also growth of my investments. I want to balance the two.
And so what do you think is the risk? What are the most serious risks that could impede the preservation and growth of your capital?
So investing in assets that are essentially depreciating, losing their value, right? Not being able to.
What kind of assets generally would you think of that have the chance to?
High volatility stocks.
Yeah, see that. So let's do a full stop.
Yeah,
even you. So not at all risk. So volatility. So a guy named Harry Markowitz in the 50s came up with modern portfolio theory. Won the Nobel Prize. Yeah. And essentially what he added to the field, I look at it as a detraction, but what he added to the field to win his prize is, instead of comparing one portfolio to the other based on historic data and saying which one is most efficient and likely to do well prospectively, so wait a minute, we're missing a variable. We're missing a risk factor. How do we know this is maybe doing better, but what if it's more risky? And so he determined that he should be using as the risk factor variance, up and down movements around the long-term uptrends, or volatility. And so the whole industry now embraced that definition as risk, volatility. And to me, it's an illusion. It's not risk. So, but that's why I had you stop, because it doesn't matter who I'm asking. We're trained to think that way. So the industry misdefines risk and safety measuring it in terms of the chance of losing our principal, and not losing it in the sense of having it disappear. Because if you invest in any diversified portfolio of companies, we call them stock, let's just call it the S&P, no one's ever lost a penny. We're near new all-time highs today through all kinds of recessions, pandemics, presidents, Democrats, Republicans, interest rates as high as 20. It doesn't happen. It's an illusion. So that's not the risk. That's not how you're gonna have your endeavor to grow and protect your wealth impeded. There's two risks that I see. One is an external risk, and I call it the disease of money, and that's inflation. Bonds, gold, all the things that freeze your money and the level of interest, whether it's 5%, 10%, for the duration that you hold these investments, those are the carriers of the disease. Because inflation is going like this, and the investment is like this.
Yeah.
That's the only way that true people who invest have lost the money, is by investing in the things that the industry tells them they should invest in to address the illusory risk of volatility. You get older, have 40% bonds, have 50% bonds, have return, and they're killing your wealth, because the temporary fluctuation in the numbers. If I had $10 million a month ago and then went back 5% down 2 back-to-back days, now I have, instead of 10 million, 9 million. I've temporarily lost or fluctuated down by $1 million.
Yeah.
And to me, oh my God, it's too much risk. But in the reality is, not only historically has it always come back, it's going on to new highs. So the number of dollars has never been a problem. It comes back. It's the solution for the illusory risk, putting more bonds and things in there, so you have less of this that will freeze your money. So now you're each of those dollars, instead of 10 million temporarily becoming 9 and going back to 10. Each dollar in bonds takes every one of the dollars and kills it by 3% every year at a minimum. And that's permanently gone. That doesn't fluctuate back. That's the disease of money. So when we misinterpret what risk and safety is, so if we now redefine measuring risk and safety, not in terms of protecting our principal from fluctuating, but in terms of protecting our purchasing power from disappearing, we recognize a couple of things. One is, wow, not only has the industry been telling me something that's different than what I need to know, that bonds are risky, but they're telling me the opposite. They're telling me that stocks are risky. They're telling me the opposite because investments that lead to the preservation and growth of my purchasing power, that's what I'm trying to do. I'm trying to grow my wealth. Those are safe, I'd argue. That's real assets. That's stocks. That's real estate. That's not paper assets. Bonds do the opposite. So now I've got to teach every investor not only to unpack the baggage that they've been misled to pack, which is that bonds are the safe thing. It's that investments that lead to the preservation and growth of my purchasing power, those are safe. Stocks are safe. And investments that lead to the freezing and diminution of my purchasing power are risky. Bonds are risky. It's the opposite. And so what we do is we teach investors that if you're going to succeed, and again, if I say stocks, real estate, they're all growth assets. It's all interchangeable. Just I teach them that you need to take that in and understand that. Once you understand that, it's kind of easy to say, oh, you're right, I shouldn't have too many bonds. The problem then becomes, they say to me, so you don't believe in bonds? I say, no, I believe in bonds, just not for the purpose of addressing an illusory risk. Volatility. Right. I believe that we should have bonds or cash, something that's very liquid, that doesn't fluctuate a lot, because when we're 2 years away from retirement, we should have 3 years worth of spending. Yeah. So let's have 10 million and I spend 400,000 a year. I should have about $1.2 million outside of stocks in this thing that I can switch to so that we protect against what's called sequence of return risk. So if I invest in stocks over the next multi-decade period, always will have gotten something like 8 to 10% a year on average, but I don't know what each of those years for my 30 years of retirement will look like. So to protect against a bad sequence like 08, 09, down 60%, I can then switch to the 3 year spending. And why is it 3 year spending? Because the average from a peak in the stock market, the S&P, to a trough and then back to new highs, that's taken 40 months since the 1920s. So as long as I've got 3 years spending set aside. So now think about that. In the industry parlance, the advice would be 60-40 when you're retiring, 40%. Right. In my model, it's going to be 90-10, 10% bonds, because there's different reasons. The extra 30% that the industry is advising on average, but a client who's retiring in their 60s with a 30-year time horizon, that's an extra 3 million per 10 million that's frozen. So in 30 years, it would be still 3 million. You'd have long since run out of money. In equities in 30 years, or real estate, or some growth asset, at just 7% a year below long-term trend line average, that same 3 million, that's still 3 million in 30 years, that's worth maybe 300,000 if inflation, it would be 24 million. It would double 3 times at 7% a year. So think of the magnitude of what's being destroyed because the industry has it backwards. And the way they have it backwards, unfortunately, dovetails with our biases. Loss aversion bias. We dislike the pain of a loss twice as much as the pleasure of a gain. We feel the pain of so our whole approach is to find investments that minimize short-term loss chances, maximize short-term pleasure, not that maximize long-term gain potential. Right. And so it feeds into each other.
So thinking about the audience base of this particular podcast webinar, those being people who aren't near retirement mostly, right? They're 10 to 20 to 30 years out.
Right.
What should they be thinking when they think about the current environment, high inflation, or getting to be high inflation, and yet they have an investment horizon that's, call it 20, 30 years additional investment?
So it's a good question because what they are thinking is what they shouldn't be thinking. So in other words, right. So there's 3 magic numbers when it comes, from my perspective, when it comes to investing. The numbers are 10, 6, and 3. 10 is the past 100-year average return for S&P 500 for U.S. large cap stocks. 6 is the same return for similar types of companies, because you didn't always have the same exact ones, but aren't apples to apples, bonds in those companies instead of stocks, 6%. And then 3 is inflation. So now if you take the 10 for stocks and subtract out inflation, it's 7. If you take the 6 for bonds and subtract out inflation, it's 3. The bottom line is we all need a lot more 7s than 3s if we're going to make it in terms of preserving and growing our wealth. So that's how basic it needs to start. Once you start with that, then someone says, okay, but given the current environment, tariffs, inflation, pandemic, economy shutdown, whatever it is, the current environment. It's in a current environment. What portfolio moves are you suggesting that your client make in response to the environment? And what portfolio decisions should your clients be making? Because that's kind of what you just suggested, right?
That's right.
And the answer is there are no portfolio decisions that my investors need to be making. They made them all already when we sat down and did a plan that we determined needed a lot more 7s than 3s. Because Trump is president or there's tariffs or there's a pandemic doesn't change the fact that for my next multi-decade period, I still need a lot more 7s than 3s. Right. So nothing should be done differently. You see, that's the whole thing. And so if you're going into a period of higher inflation, which, by the way, I believe we are, simply because our government and many of the other industrialized country governments are producing debt and deficits at a much faster clip than they're producing GDP or economic growth. Mm-hmm. And that has to show up, in my view, in inflation. Mm-hmm. So we're going to be in a higher inflationary period for the next 3 decades likely than we were in the last 3 decades, much higher. And so when you look from 1960, the first year in the decade I was born, we went through terrible inflation in the 70s. Right? We went through record high. It was almost 20%, much worse than we had a couple of years ago when I hit 9%. And when we look at the CPI, the inflation index back in 1960 was something like 30, and now it's 300. So it's gone up 10 times. The S&P in 1960 was 60. It's gone up 90 times. Okay. So there's no better inflation killer than real assets, than stocks. Both in terms of the appreciation relative to inflation, the dividends have grown by 6% a year. So the dividend in 1960 was something like $2. Today it's 76 on average that the S&P is paying out. So if I was making $2 on a 60 price of the S&P back then, it's a dividend yield of like 3%, 3.5%. I think it's 35,000. Today it's up 35 times that. I'm making over $1 million on my original $1 million investment, just in income.
Right.
With inflation going up 10 times, I would need 350,000 to buy what I bought for 30,000. I don't have over $1 million. Right. So that's the answer. In other words, people like to come up with these narratives that seem to lead them to want to change the all of history and what's worked. They have to look back from the period I just talked about, 1960 to today, when the S&P has gone from 60 to 5,400. What also happened is the S&P 500 has done something 3 times, then it's only normally does 1 or so in 100 years, according to Charlie Munger, which is go down to half. Right. And it did it in 73.4 in 2002, and then only 6 years later, in 08 and 09, went down to 60%. So that happened. That was 3 times in half, including those 3 halvings since 1960. You had about 13 or 14 bear markets, down at least 20%. In addition to those 3 halvings, you also had something like 10 recessions, and you've had almost an equal number of Republican and Democratic presidents. You've had war and peace. You had the Cuban Missile Crisis, where it could be blown up 90 miles off the shores of Cuba by Russia, and people were changing their life plans because of that. And you can go on and on and on. So with all of that, the S&P made 10.25%, 10.5% a year for that period. And what did someone have to do to garner those returns as an investor? The single most important thing they had to do, unfortunately, is also the hardest thing for them to do.
Yeah, do nothing, right?
Nothing.
Yeah.
That's it. I hate to make it sound so simple, but that's what it's all about. And, we have an action bias. So if you've ever seen a person by the elevator going like this, right? It doesn't make it come faster, but we do have this action bias. If you've ever been on the highway and see, you may drive like this, I don't call them a lunatic, but you see that person, go weaving in and out of lanes. What they need to realize is the average lane speed is the same. The person who doesn't weave gets to this endpoint almost always the same time they do.
Yes,
the difference is they jeopardize their chances of getting there because they're going to get into an accident. Same thing in investing with performance chasers. Your average returns are going to be what they are over multi-decades. You're not going to outsmart the markets and the indexes.
Yeah.
You may some from time to time, right? But you have a chance of blowing yourself up. You're like that driver. So the action bias causes us to do a lot of bad things. And in investing, I always say, it's not, don't just stand there, do something. It's the opposite. Don't just do something, stand there in response to the tariffs, to the pandemic shutdown, to the Japanese bubble bursting, whatever it is. Just keep diversified, let it compound, rebalance. Just don't do anything to change your plan in response to whatever it is you're afraid of. Feel the fear. It's normal. I'm not telling you not to feel it. Just don't reflect the fear by changing your long-term portfolio strategy. You still need the more 7s than 3s, no matter what's going on currently.
Now, are there moments in time that change your perspective and your investment strategy? And I'm thinking, like, I invested in the high-tech era of the 80s, right? And 80s, 90s, when the stock market just took a tank, hit the NASDAQ, sheared it in half or more, and I lost a good deal of my portfolio. That left a bad taste, left a scar of how I invest going forward for some time. But I'm invested in probably 70% in the equity markets today. Are there some moments in time like that where it kind of the extremes that doesn't adhere to the strategy of staying put, stay invested?
Oh, I guess the question is, could you tell me a period where it would have been beneficial for a multi-decade investor to adopt a different strategy?
No, I mean, that's correct.
So that's the answer. Okay, so no, of course not. I mean, the reality is what you just described to me. What drove you to have more bonds as a permanent part of your strategy, 70-30 instead of is something called regret aversion bias, right? So regret aversion, where we engaged in some activity with our money where we were really loathsome of the outcome. We had this terrible outcome. And in order to avoid that outcome ever happening again, status quo bias. Leave more of it in bonds because at least that piece, this can't happen to.
Yeah.
And that's what happened to you. Now, when you understand that, so the short-term regret aversion, myopic regret aversion, I'm going to keep this bonds, at least in the short run, but you still, that 30% in bonds is killing your money. It's turning that money into wallpaper.
Yeah.
Long enough time. So you want to unwind that if you can, right? You want to get your temperament strong enough to recognize if you look at your entire history from the time you were born, the history of the stock market, you'll see, I don't care whether it's you or anyone else who 10 plus years it's always going to be the same. There's going to be a lot of bad things that happen and your returns will almost always have been much better than if you had fixed income.
Yeah.
So if you're working, the only reason you need fixed income is up here, maybe 6 months worth. That's it. But when my clients are retired, I do 2 to 3 years living expenses. For someone who's working 30% in fixed income, it's like, take a match to it.
Yeah.
But on all kidding aside, if in fact having that 30% allows you to keep 70% in equities, and if you didn't have the 30%, you'd never stay. If you had 85% equities, you might be forced to sell them emotionally. Yeah. And you're better off keeping the 30, right? Because you won't stay with it. So that's all. It's not an absolute, but just from a financial standpoint, having 30% bonds is for someone who's working and doesn't have 2 to 3 years living expenses needed in a down market. It's going to be a big negative.
Yeah, and I should clarify, the 30% is not bonds. It's like alternative assets, like real estate. And
something that's not stocks. Right. So, my mentor is a guy named Nick Murray, and he always says he's looking at the endowments and the foundations and stocks, public equities now, maybe 20. At one point, it was at 20%, 25%. So he's saying, alternative to what? The alternatives are the main these days for most people because they're so distasteful of stocks, but whatever. So the alternative to what? If that thing represents 50 or 60%, it's no longer an alternative.
Right.
So the alternative to the 10% a year that grows dividends without any effort, without any lockups, without any liquidity, at 6% a year. It's just, I don't get it, but I get it. You know what I call it? I call it most, not necessarily what you're doing, but like the alternatives, the private investments and all this stuff. I call it the financial and bonds, financial Ozempic. So I've always had a weight problem, right? I've had a weight problem my whole life. And I know intellectually I shouldn't take Ozempic. I should learn how to eat and exercise better, right? And regular regimen. But it's easy to take the Ozempic.
Right.
In investing, I can teach people how to have 90% or more in equity and stay with it as their behavioral investment counselor.
Mm-hmm.
I could be the coach to teach them how to eat well as it relates to investing, right? And exercise. Or I can be the advisor that says, let's take the Ozempic. Let's go 40% bonds, 50% private equity. I mean, and there's side effects to that Ozempic, right? The side effect, what's the side effect to the bonds? It'll reduce the short-term volatility. It's going to kill my money. That's a big side effect. It's going to lead to the disease of money taking over. What's the side effect of some of the illiquid alternatives? So I'm going to give you something that's interesting. And I'm looking down because I purposely took a picture of this email that was sent to me recently. So there's a firm called Alto. They're a big alternative investment firm. And they were being interviewed for an article given the recent volatility in the stock market, public markets. It said, quote, the neck vertebrae damage inflicted on owners of alternatives, often referred to as private market assets, however, has been far less than equities during this period. That's primarily because most of these private investment vehicles are not marked to market, thereby eliminating the need to check prices by the day, hour, or minute. You shouldn't check the price on your phone all the time, regardless, and so on and so on. So think about what I just read you. They're not telling you that those investments are better for you because they did better. They're telling you because they don't mark to market.
Right.
We're fooled into thinking that so now what's the side effect of those investments? Well, if I need money and I've been convinced to put too much money in those things, what do I have to do to get my money? I've got to sell the things that are temporarily down and liquid. Yeah. That's a big side effect. So you see what I'm saying? So I get into all of these things all the time. And I just, I'm not saying there's no place for alternatives. What I'm saying is it's taken over at a point where it's the availability of alternatives of all kinds are being democratized so that they're available to the retail investor. And I know from doing this for 35 years, once that happens, the lights start to go out. People at UBS and Merrill Lynch and Goldman are usually not getting the best things. They're getting, there's a lot of demand for these things now, and they're getting whatever dripping down. But the big people kind of said, I'm going to pass on that. And so to me, there's big danger signs going up there. But the very fact that this comes out and says from one of the biggest alternative shops that the reason this is helpful is because we fool you into thinking that it hasn't gone down like that, but it's not marking to market.
Right.
So, this to me is just insanity.
Yeah. If you take an average investor, let's take our audience investor, high tech, well paid, and you plate them against an ultra high net worth investor, what's the primary difference? Why is the ultra high net worth at that level and maybe the average investor at the average investor level? Is it not necessarily that they're invested in the stock market, or is it?
No, it's not. I would say on average it can't be, because they're all making the same mistakes. Most investors making the same mistakes, human nature, and most of them are being advised by the traditional industry advice of 60-40 alternatives. And what, so it's not that. They're all kind of getting at it the same. It's that the Tiger 21 people made their money in real estate and family businesses. They just happen to have a lot more money.
Yeah.
Right? And one of them said to me, I understand your philosophy, Jonathan, but you know what? I don't need to take the risk of buying stocks, even though I was teaching them stocks are not risky. They're risky the way you've been to it. They're not risky in the real world. They say, yeah, but I can afford to do this, that, and the other thing. I said, look, just because you can afford to make ill-informed investment decisions, it doesn't mean that you should.
Right.
You know what I mean? So when you're dealing with the really wealthy versus maybe the average clients that you're targeting on the podcast who may be doing well, but not at that billionaire or millionaire level. The difference is really just what they made from their businesses. That's most of it is not from successful investing. You could read the article on my website that was published by Barron's in the middle of 2020 on the mistakes that the ultra wealthy make, and it highlights Tiger 21. And Barron's published it. I used their own research, and they published the article.
Yeah. What are those mistakes? If you can highlight it really quickly.
Yeah, so they say that, for example, they said that in 2010, when they put out their quarterlies, sometimes what they would do is put out, what's our favorite fund as a billionaire investor group? So in 2010, their favorite fund was named as the Fairhaven Fund. Bruce, the guy's name is Berkowitz. So in 2010, and the reason it was their favorite, it made something like 260% over the 10 years or something like that, where the S&P lost money. That was the lost decade for the S&P from 2001 to 2010, after the tech bubble burst. But that fund made money. So that's why it was their favorite. It's performance chasing, nothing, no different than anyone else. And then for the next 10 years, the Fairholme Fund was ranked as one of the bottom 7 funds in the entire universe of stock funds, right? The same year, their favorite stock, Berkshire Hathaway, preceded the only 10-year decade, or one of the few 10-year decades, for decades where Warren Buffett's Berkshire Hathaway without underperforming the S&P, right? When they lived 10 years after they named it their favorite. So the founder of Tiger 21, because of something called affinity bias, where we want to be invested in something, not because it's necessarily a good investment, but because the status of being accepted into that investment puts me on equal footing with other people similarly situated to me in the wealth spectrum. So Madoff, okay? So that's the founder of Tiger 21, Michael Sonnenfeld, has a separate entity, his own investment vehicle called Muse, M-U-U-S. And 10%, from what I remember, of Tiger 21 investors were invested in Madoff. Worse, they got there in many cases through his recommendation or guidance through Muse. Right?
Yeah,
right. So it's the same mistakes everyone else makes. And why do you go to a Madoff? Well, you go there because of affinity bias. It's a club I could get into that I don't get into. But also you go there because of something called authority bias. Well, if Fred Wilpon, the owner of the Mets, did the due diligence, he invested. And if the guy who created Star Wars, he invested in it, got to be good enough for me. I don't have to look at it.
Yeah,
That's bias. So all of these things, they don't discriminate against one or the other. You know, whether someone's young or old, wealthy or not wealthy, they're not likely to mistake more than the other yield for total return, yield of income for total return. They're not likely more than the other to misclassify risk as volatility. It's all the same, right? That doesn't change. But the wealthier and more successful we are, the more we have overconfidence, which holds that big magnifying glass on loss aversion, regret aversion. So you're exhibiting the biases worse than everyone else because of the magnifying glass, because of your overconfidence.
Got it. Okay. We're almost at the top of the hour. One question we always ask our guests is, what, if you look, call it 30, 40 years back, what's one thing you would tell a younger version of yourself?
Learn how to eat right and exercise.
Yes. Yeah.
That's what I'd still tell it today. I still haven't figured out. I would say, learn how to spend time listening to people who have a lot of experience more than you do. And much more time listening than trying to show what you might know early on. Because that's really how I've learned the most. And I didn't always practice that, but that is how I've learned the most.
That's great. And then the other question is, how do you give back to your community?
So we have a couple of things. So there's one charity that we support called Sunrise Organization. And what they do is they were founded to send children with cancer from underprivileged families. So there's two negatives. They have cancer and they're underprivileged economically, and their siblings to camp all summer. So the reason the founder came up with that idea is because when you're an underprivileged family and you have a multi sibling family, now one sibling has cancer, you have to take care of them, but you also have to work because you're underprivileged. So now if you have to take care of them, you don't have time to worry about your other kids. So now having this summer camp that lets the siblings, pays for the siblings and the children who are afflicted with cancer, it does wonders for the whole family unit. So that's one of my favorite organizations. So we support them. And then we just hired a young person who's 24, and I'm mentoring them to become a financial advisor. So in a way, I just, one of the podcasts I just did with one of the leading recruiters in our space, in the investment space, she said, when I said, what do you recommend for young advisors? She said, the most important thing is get a mentor. You can do it in a big firm, you can do it in a firm like yours. And I shared with her, well, we just did that. We just hired a young person and I'm his mentor and taking invested interest in him. And she said, that's the best way to give back in your industry.
That's fantastic. And thank you for all that support. Thank you very much for the fantastic pearls of wisdom you imparted, Jonathan. How can investors find out more information about you, your podcast, Fusion Family Wealth?
Yeah, Fusion Family Wealth. Thank you. Thank you. So yeah, so best thing they can do if they're interested in learning more about us is fusionfamilywealth.com. That's our website. On the website, we have our insights section, which is all of the articles we write. We wrote about the pandemic. We write every quarter something that attacks the behavioral aspect, temperament aspect of what you need to do to succeed. And then our podcast is also on its own website. In addition to the firm website, it's called crazywealthypodcast.com. So all of those things are educational tools, and I think those are the primary ways to learn more about it.
Great. We'll include all that contact information and the podcast in the description of this particular podcast episode. And for ours, don't forget to like and subscribe, ring that bell to our podcast and our webinar on whichever platform you're listening to make sure that we can continue bringing you the best educational content like this one. And thanks, everyone. Until next time, keep learning to invest for generational wealth.
All right.
Thanks, John.
Thanks so much for having me, John. I appreciate it.
Thank you.